Welcome back to Engineering Influence, the podcast from the American Council of Engineering Companies. And today's episode delves deep into one of the most significant legislative victories for the business community and engineering firms in particular. And that's the recent passage of the One Big Beautiful Bill, the tax reconciliation package that recently passed the House and the Senate. Now, this sweeping legislation delivers on longstanding tax priorities for ACEC and marks a powerful moment for our industry on Capitol Hill. And it is a complicated thing. It's not a small package, so we need to delve in with an expert. And joining us today for the discussion are Katharine Mottley, ACEC's VP of Tax and Workforce Policy, and Jake Triolo, partner with Capital Tax Partners, group that helped us in our advocacy efforts before Congress and the tax writing committees to get this bill across the finish line. And we're here to unpack some of the bill's key provisions and what they mean for our firms and our members. We'll explore how ACEC's top advocacy priorities shape that final tax package, some of the meaningful wins, permanency of the 199A 20% pass-through deduction, permanent 21% corporate tax rate, significant developments on R&D amortization, which has been a significant priority for us, and a lot more, because this is not a small thing. We'll take a look at the business side, we'll take a look at the energy side, and then we'll look at what might be coming next in the world of tax. So without further ado, thank you for joining us. And I'm going to kick it over to Katharine to start the conversation. Katharine?
Great. Thank you so much, Jeff. And Jake, welcome to the podcast. We're happy to have you here. So we have been lucky enough to work with Jake and his colleagues at Capital Tax Partners throughout this process. And that's why we asked Jake to join us today, so we can really, as Jeff said, unpack what's in the bill and how these provisions are going to affect engineering firms across the country. So Jake, I don't know about you. We, as you can tell, we think that from a business tax perspective, ACEC member firms did really well in this process.
Yeah, I think that's right. And I know you and I have talked about the fact before that there weren't quite as many hairy moments during the process as well. Sort of from the beginning of when the first House bill came out to the very end when the Senate bill was passed and then subsequently signed into law, the priorities that ACEC had generally were taken care of through most of the process. So a lot of that just has to do with good advocacy and having member companies and an industry that's pretty popular with members on the Hill.
Absolutely. And so we were really pleased. There are two broad issues here. One is something that we also advocated for in 2017 during the Tax Cuts and Jobs Act. And that was, balanced tax treatment of all of our member firms, whether they're organized as C corporations and use the corporate rate, or as, S corporations, partnerships, and use that pass-through deduction, the Section 199A deduction. And we were really pleased to see that both of those are now permanent in the law. And that's helpful for firms so that they can plan and invest and grow.
Yeah, I think that's right. And I think that was sort of the big theme that Republicans on the Hill were sort of focused on throughout this entire process was certainty, right? And you saw in the media a lot of back and forth about how exactly do you score the bill? How much money does it cost? And that entire discussion was sort of, to your point, focused around the idea of we need to make sure to give businesses, both big and small, good tax policy, but also certain tax policies so that you can kind of go into long-term planning and have a fairly good idea of what exactly the taxation structure is going to be as you look to the future.
Another key priority that we've been working on for the last several years, and this actually kind of harkens back to that 2017 law, it was that change that occurred in the 2022 tax year from what used to be policy for decades, being able to deduct R&D expenses in the year that they were incurred, to shifting to an amortization schedule. So having to spread those expenses out over several years. And this was a huge issue for ACEC and an area where we spent several years advocating and trying to help our Hill allies build support. And we were delighted to see that permanent fix was also included in the law. And I think we definitely want to make sure to always remember to thank our champions on the Hill. This was one of the issues, even though the OB3, as I like to call it, was a partisan exercise, as the reconciliation process typically is. But fixing R&D really had bipartisan support. on the Hill for the last couple of years.
Yeah, and I think it's important to kind of think through exactly what happened here. I mean, for you and I, Catherine, we spend every day kind of thinking through what's going on in the Hill and what's expiring and why is it expiring, and probably all your listeners don't. So I think it's important to do a little bit of a historic rewind. So, the Trump bill passed in 2017, the Tax Cuts and Jobs Act, and just like you heard in the debate this year around the big beautiful bill, there had to be pay fors to help offset some of the costs of, in particular, lowering the corporate rate and creating the 199 cap A structure, which many of your members greatly benefit from. And one of those pay fors was, as you said, taking away immediate expensing of 174 R&D expenses and instead moving to an amortization structure. I think it was pretty quickly after that 2017 bill passed that members of Congress started to realize that maybe that wasn't the greatest policy. And there was some effort over the years to try to unwind what eventually went into effect at the end of 22, as Catherine talked about. I think businesses like your members were especially effective in sort of highlighting some of these problems, because when Congress started to hear from folks that were talking about mortgaging, putting second mortgages on their homes, and just the impact it was having at the small business level, there was really a bipartisan decision and a bipartisan effort to try to fix this. And sort of that came full circle to what we saw in the big beautiful bill. And as Catherine said, I mean, really sort of the threshold item was getting the full expensing back at the date of enactment. And that did come into play. That was passed. And as Catherine said, that benefit is now made permanent. So we don't have a cliff that we have to worry about like after the 2017 bill. The other thing that's really important, and ACEC spent a lot of time focused on, and I think as Catherine noted, your champions, Senator Todd Young from Indiana in the Senate in particular, they really championed the idea of giving additional benefit to those small businesses who would sort of come in and walk through and explain why this had such a tangible impact on them over the last couple of years. So there is retroactive relief for businesses that have under 31 million in average gross receipts, and you can amend your returns going back to 22 and 23. Now, I think regardless if you're below the 31 million or above the 31 million, there is optionality built in the structure. You are not required to deduct immediately. That they are allowing you rules to sort of, as you're amortizing, to figure out how to finish amortizing over 5 years and then transition to a deduction. There's all kinds of optionality built around it. So, I think it's important when you talk to people like Catherine and I, we sort of play lawyers on TV, I guess, but even though I went to law school, we always recommend when you're thinking through things like this, where you have optionality, meet with your tax account, make sure you're talking these options through them, be aware that they exist. So when tax time comes around next year, you're prepared to make a decision that best represents what's written in the law and the optionality around it.
Indeed. And isn't it also true that not just the smaller firms, which can go back, as you said, for 22, 23, and 24, or one of the questions we got from one of our firms was, what if they haven't yet filed 24? If they had filed an extension? So again, talk to your CPA, talk through what your options are. But even for larger firms, they provided an avenue for speeding up some of those unused deductions as well.
Yeah, they're giving you an optionality around either you just enter into starting to deduct immediately the following year, or they're giving you a 60-month recovery period, or there's a 10-year option as well. So absolutely, there are options built into it. I think one of the things that is a little uncertain still is there's some definitional issues that need to be hammered out, and there need to be rules sort of laid out for how exactly you go through the process of amending and things like that. So that will come out through Treasury guidance at some point. We don't yet know if it's going to be through a notice or through a regulation, but and I think we'll get into this later, but the Treasury Department and the IRS are going to have to figure out how to provide you and your tax advisors with information as to how optionality exists in all kinds of different structures, including the 174 provision.
Indeed. So, I mean, all of these pieces taken together really help our members to be able to invest, to be able to grow, to invest in their workforces. We learned in a study that we did earlier this year on the impact of the 2017 law that that's really the space where our members invested. 82% invested in their workforce, about half invested in new technology. And with AI entering into this industry as well as others, that's a significant piece, and they'll have those abilities going forward. So we really were pleased with the outcome on the business tax side. So we also want to talk about some of the other provisions in the bill. And while this was, as we said, sort of a really good result for the engineering industry, there are some energy tax provisions that were changed in the law as well. And this was more on the pay for side. And also a goal of some Republicans in Congress was to make changes to this renewable energy tax credit space. So Jake, could you talk a little bit more about what they were going after and what some of the changes are in the new law?
Yeah, so I'll kind of do a long run up into that because I think it's important to kind of make a point that we hit on a few minutes ago about business certainty and the benefit of having tax permanence on a lot of these provisions. So over the last couple of years, Congress has sort of started moving bigger tax legislation, going back to the Affordable Care Act, through what's known as the reconciliation process. The benefit of the reconciliation process is that if you are a majority party, the Republicans or the Democrats, you control the Senate, the House, and the administration, you're able to move something through the Senate with less votes, and you can do it without working with the minority party. Okay, that makes it easier to move legislation, right? Because you don't have to like work in a bipartisan fashion to get something done. The problem with that, though, is if you do something in a partisan fashion, the next time the minority party's in charge, they may want to unwind it and do something of their own, right? And you'll remember this. I mean, everybody has seen in the media, attacks on the Affordable Care Act, attacks on the 2017 Trump bill, and obviously Republican attacks on the Inflation Reduction Act. So the Inflation Reduction Act was passed in 2022, and for the purposes of our conversation, it had a very significant amount of reform to the way energy tax incentives were created within the Internal Revenue Code. I think, sort of for lack of a better term, in 2022, we sort of moved a significant function of energy policy from the Department of Energy and into the Department of Treasury and the IRS, because essentially any sort of green sort of energy that you were producing, there was generally now a credit that existed for you to incentivize that production. Okay. And so that was a big Biden priority and something they passed, as I said, in 2022. So going back through this last presidential election, it turns out that the IRA ended up being sort of a flashpoint, right, in the political world. And I mean, it played a huge outsized role in presidential conversations, but also in congressional conversations. And Republicans were very adamant that they were going to unwind and they were going to repeal the Inflation Reduction Act. So that sort of gets into what Katharine just brought up, which is what happened with the energy taxes. And I mean, short answer is a lot, right? And as I talked about the 174 provision back in 2017 being a mechanism to help raise revenue, to help offset some of the costs of passing the Trump tax cuts in 17. Like in 17, the Inflation Reduction Act was used essentially as a piggy bank to help offset some of the cost of extending 174, extending 199 Cap A, extending the individual cuts, all of those things that expired at the end of 2025. So what sort of happened, big picture, is that the big beautiful bill raised over $500 billion in paring back the Inflation Reduction Act credits. And these modifications impact really everything, right? Because the big picture things that we talked about when those were done were the wind and solar credits. But for an industry like yours that is building, these, residential and commercial buildings and all these different things, are designing them, things like 179D, energy efficiency credit that your industry's always cared about, that is essentially repealed, right? So the Republicans generally went through the entire Internal Revenue Code and they identified some of these like green energy credits that they didn't like, and they are very abruptly phasing them out. I think what we've heard the most, though, from your memberships, Katharine will correct me if I'm missing any credits, but it is sort of on the wind and the solar side. So what the Inflation Reduction Act did back in 22 is it took sort of a litany of credits and smashed them into two credits. And it was a credit that gave you an incentive for energy production, so an energy production credit, or energy investment, so an investment credit. And essentially, if you created energy that was carbon neutral or didn't produce carbon emissions, you were eligible for these credits. And the benefit to them were not only were the credits fairly generous, but there were also an allowance for taxpayers that did actually have tax liability. You could sell or use the credits yourself, basically create refundable credits. So this was a very, very big incentive to a lot of the green industries. So on those big credits, on those tech neutral credits, essentially what they did is if you produce wind and solar, they're going to give you one more year to begin construction on a project. And if you don't begin construction within that 1 year, your any project that you or your customers build has to be fully placed in service. In other words, producing energy by the end by 28 by the end of 2027. So it's a really quick cutoff, right? Really, really quick. And then to add on top of that, if you're doing anything within these wind and solar credits, you're also going to start being subjected to foreign entity of concern rules. And then that's just beyond just wind and solar. If you're doing nuclear power or a hydrogen or whatever, there are these new foreign entity of concern rules that have to do with trying to limit the amount of inputs that are coming in from places like China and Russia. And so those are things that your customer's going to have to start paying attention to as well. So I think overall, big picture, there's a lot of consternation in sort of the green energy space, sort of figuring out the new normal, but also figuring out sort of the rules for these phase downs that I just described as to when you begin construction on a project. And I think we'll get into that a little bit more, but generally speaking, that was sort of what took the hammer versus everything else in the bill. I think generally speaking, most of the stuff on the tax side that was included in the big beautiful bill was fairly beneficial for taxpayers, and then the green energy stuff that's sort of where the money was raised in order to do the offsets. So.
Yes, and that is an area where ACEC is going to continue to engage. We certainly advocated with Congress trying to get the most beneficial phase outs possible. But as Jake was saying, in this area, this was, I would say, in some ways more of a political issue than a policy issue. Apart from the piece of raising revenue, it was necessary. They needed that revenue for sure for the new law, but there was a big political push here too, and so we would still like to see improvements in this space because this is an area where a lot of ACEC member firms do design work, designing all of these different types of energy systems. To borrow a phrase from Senator Langford, they do all of the above and all of the below in terms of energy work. And so we definitely want to continue working on our members' behalf, trying to make this situation the best that it possibly can be.
Well, I think it's important to note too. I mean, the industries will change, they will adapt, and also you would think, but also the target was more focused on wind and solar. So there are other types of energy that were included in these credits that didn't necessarily get as harsh a phase out. So industry may grow there as well, and things like nuclear and other technologies, they have a more generous phase out, and they don't start phasing out the begin construction requirements till 2034. So there's a much more generous window that those are able to fit into. I think the other thing, and this is sort of, this covers what we already talked about with Section 174 and some of these other provisions. The guidance matters, right? I mean, we have a general outline of sort of how these energy credits are going to work and what the phase down is going to look like. But there's been a big hubbub in DC over the last few days that there was an executive order related to the wind and solar credits, where it seems like the administration is trying to change some of the existing guidance that sort of tells you, the taxpayer, when you begin construction. And again, that matters a lot because, as I said a minute ago, the safe harbor that wind and solar projects were given is they have 1 year to begin construction from the date of enactment. So how begin construction is defined in the rules matters a lot. And I know we've heard from some of the ACEC members that are really interested to see how that plays out. And over the next couple of weeks, we will start finding out. But just because you read the letter and the statute doesn't mean that's the end of the story. And so make sure to stay in contact with Katharine and others on her team to understand exactly what else is going on to kind of provide the rules of the road for how all this works.
So, Jake, that is a great pivot point there. Let's talk about sort of looking ahead, and let's start with the regulatory process. We know that this law is going to require a lot of regulatory work from Treasury, also other agencies that have other pieces of the bill. But from a Treasury perspective, so you mentioned the executive order that came out a few days after the law was signed. We suspect that that executive order was perhaps prompted by some of the conversations the president had with House Republicans in the waning hours of trying to move the bill through Congress, and there probably were a lot of discussions on this front. But those kinds of questions, things like beginning of construction, where there is existing IRS guidance of some form on what that looks like, what the definitions are, but those could change, isn't that right? I mean, they could come through and say, no, you actually need to show more to demonstrate beginning of construction.
Absolutely. And there are different mechanisms dependent upon how the rules of the road are set out, either through formal regs or sub-regulatory guidance. There are different mechanisms that an administration or a Treasury Department has to go through in order to sort of change the rules. So depending on what you're interested in, it's going to be different, right? But Catherine's exactly right. There are a lot of questions created here. Now, it's not as many questions as was created in the IRA and the Tax Cuts and Jobs Act, because much of this bill was just renewing or extending existing programs, right, or existing credits. But in the energy space, there's a lot of questions to be answered, but also things that Treasury is going to have to focus on are some of those, no taxes on tips, no taxes on overtime, things like that are new concepts to the code. They're going to require guidance that explains to taxpayers how exactly to implement that, how their employees benefit from it, etc. And I think what you'll see over the coming months, and this is a point sort of educated by what we've seen in the past, but what you'll see over the next couple of months is the administration, the Treasury Department will likely come out and start to outline different items that they are prioritizing from the perspective of regulatory guidance. For things that are very, very immediate questions that must be answered, you will likely see some notices come out of the government that kind of give you like short-term answers for how to answer these questions that you have as you're trying to figure out these different programs. And for longer term answers, eventually we will start to see draft regulations come out, and then final regulations that sort of set permanent policy around what exactly it is you have to do in order to comply with the new rules that were created in the One Big Beautiful Bill.
Yes, and that is why ACEC is going to continue to engage with Treasury. We're going to be talking to them about, yes, definitely about the energy regulations and notices that we expect to see, but we are also going to talk to them about other issues as needed. If they need input on R&D and kind of what that looks like for our members, we are happy to engage in that space as well.
And that's important because that so often things that are written in the statute are intentionally vague or intentionally like leave deference to the regulators to figure out how best to implement them. So be it taxes or I'm sure any other policy area that ACEC is focused on, the legislative process is not the only thing that matters. The regulatory process more often than not is what at the end of the day provides the rules that you're following on a daily basis to comply with, the government, the laws the government passes.
Okay, so my last question for you. You just referenced the legislative process, and we have been hearing talk coming from key members of Congress about the possibility of them doing this again and doing another tax bill. So what do you think could be coming down the road?
Well, I think it's first off important. Anytime you're pondering what Congress is going to do, the first thing you need to do is think about what they have to do, right? And much of Congress's calendar is structured around what we out here call must-pass bills. And so the must-pass bills this year are actually pretty limited moving forward. But number one, they've got to pass a government spending bill, right? And on September 30th, the current government spending bill expires. And in order for the government to continue operating, they will have to, in one way or another, renew that spending bill. Okay. So that's number one. That has to be done in September. Number two is at the end of the year that the Affordable Care Act has what are called premium tax credits. So essentially tax credits that are created in the Affordable Care Act that some taxpayers are eligible to receive in order to help buy down the cost of insurance premiums. And those are really important because in October-ish timeframe, insurance companies start to set new premium rates, and the premium rates will be adjusted depending on whether or not you extend the premium tax credits. So that needs to be done as well. That's pretty much it, right? And so I think from the perspective of what's next for Congress, they'll be gone in August. They have the month off to spend time in the districts or time back in their states over August. And when they come back after the holiday at the beginning of September, that it will be full time what's going to happen with the government spending bill. So that's all you're going to hear about for a little while, right? And then we'll see how they address that and then what they do towards the end of the year. I think as it relates to tax things, there's sort of, Katharine mentioned that there's some chatter about maybe doing more on tax, and that sort of focuses around two buckets, and neither of these buckets are required like doing a spending bill is. Bucket number one is there's a litany of tax extenders that are passed every couple of years that are sort of just like normal business for Congress to deal with. And some of those tax extenders expire at the end of the year. So that could be one driving force to do a tax bill at the end of the year. The second is you're starting to hear more and more about a second reconciliation bill. And remember what I said a little earlier, a reconciliation bill is a mechanism by which the majority party can move something through the congressional process without having to work as much with the minority party. So the question ultimately is going to be, can the Republicans unify around something they want to do independent of Democrats? And we just don't know the answer yet. You know, there are some members that are talking about doing some Medicare reform. There are some members that are talking about using reconciliation to do substantive deficit reduction. And so you'll hear some chatter around that at the end of the year. We'll just have to wait and see if either of those concepts or a new concept that might pop out are enough to drive another big bill that.
Well, one thing we can say is that we will continue to be plugged in on all of these issues on behalf of our members. So, Jake, thank you so much for joining us today. This has been a really interesting conversation.
Well, good. Hopefully we didn't provide too much information. I'm sure there's some acronyms we use that only people in DC are aware of. So I apologize for that.
That is an issue that we all deal with here in town.
Well, thank you again, Jake and Katharine, for a fantastic discussion on a very important topic for us, both as an organization and for our industry. And of course, we will be staying with this story as it develops, as more information comes from Treasury, more guidance, and we dig into the bill. We'll make sure to be getting information out on a regular basis. If you do have questions about how the bill impacts your firm, I do recommend that you reach out to Katharine Mottley on our team. And of course, as always, thank you for joining us. If you like our content, make sure to hit that like and subscribe button, ring that bell so you never miss an episode. And if you get this only on audio, make sure to subscribe and to like it on the platform of your choice. It really does help the channel, and I do appreciate it. So once again, this has been Engineering Influence, a podcast from the American Council of Engineering Companies, and we'll see you next time.